Welcome everybody once again to the webinar. Just a second, I have a sound problem here. So now it works. Okay, yeah, welcome once again to the webinar Developing Superb Trading Strategies. As always on Thursday, today we have the 10th of November 2016, and it's a pleasure for me to have you all once again here with me. And I have to say thank you to Argus FX, who makes this webinar series possible. So thanks to Argus as well. Yeah, we have a total different topic for today after having during the last times more difficult topics like class trading, like special indicators, more from a different perspective. Today we have, let's say, a straightforward topic, and that topic is pair trading. What that really means and what are the basics of those strategies, I will dig into that quite deeply so that you can fully understand and follow that kind of principal concept for finding a good trading strategy. I will do everything here today only on one pair. That means those two types of oil, meaning Brent and WTI. So the two types of oil which are traded typically at different brokers, even in so-called future contracts you can trade that as well. As always, I will start a little bit with questions because I got a list of questions to the last webinar, and I will quickly guide you through that because I want to share those informations with you as well. You might do the following now. There's a lot of text being written, and if you are more interested in all the details, I can send you the document as well. But I will briefly go through that because it might be of common interest for everybody. The first question was related a little bit to the class trading strategy and how I always do the calculation of account size, minimum account sizes, drawdowns, and so on and so on. So in principle, what I always do is that I have a certain strategy. Then this strategy typically runs on different underlying simultaneously. That means I take all those trades out of the backtesting results and fill all those trades in one single Excel sheet. So I do all the calculations on the complete combination strategy, so looking for all trades in a single way. And from that equity line or equity curve, I derive always the maximum drawdown for the time frame of the last 10 years. And this drawdown in combination with the account size gives me finally the number of what is the risk per trade. So I know then all the numbers, and what I always do is at least I double the drawdown in order to calculate the minimum account size, or in other words, that would mean that the allowed drawdown would be 50%. You might think that this is a little bit too risky, and in principle, I agree with that statement. But what we can do is everybody can do that calculation for his own. Everybody could even once again double that, and then the maximum drawdown would be 25%. So that is in principle my guideline. There was another question. Since I introduced so many strategies here, is it possible to follow those strategies in real accounts? And of course, this is possible, and I will show within the next webinars how easy it is. to simply follow via the Argonaut platform of Argus FX those kind of strategies. We will set them up, and I will, of course, inform you during that webinar what kind of strategies are there running and how to follow those strategies. It's quite easy. The only thing you need is you need an account at Argus FX, and then the rest is done totally automatically. Next question was what platform I personally use for all my backtest activities. Of course, I use Excel since I present a lot of strategies here in Excel, but that is for me always only one step. Especially if I go to smaller time frames, then it's definitely needed to change Excel or MT4 just in order to get results much faster, and then I use self-written C programs in order to do all this backtesting, optimization, and so on. Especially when I apply this back-forward testing methodology, then it's definitely necessary to have an extremely fast setup to do all those kind of calculations. Next question was about what about if I have a very small take profit stop loss strategy. So and I have already quite good backtest results. But what about if I now go with that kind of strategy live? Isn't it possible that then you might have problems with slippage, spread widening, and so on and so on, and finally the strategy becomes unprofitable? And yeah, in principle that could be, so I can hardly foresee the real results. But two things. One is in order to already foresee it a little bit, what I always recommend is that when you have the possibility to do a backtest, for example, in MT4, then you can manually change the spread for that kind of calculation. The preset for that value is always that MT4 will take the spread as it is right now, and that is, at least for my thinking, the worst choice, because typically then you have a good result, and by the way, it would depend on the actual spread of right now. But what I would do there is you can manually enter any spread value, and then MT4 will take exactly that spread value. And for example, if you have a strategy of euro US dollar, then you should increase that number, for example, to 1.6 bips, and still the strategy should be profitable. Within the night, yeah, there's still some hassle because around midnight you will realize that spread goes up to, for example, 5 bips. So then there are two things you can do. You can look to your backtest results and see how often you trade at that time. And if you write your own expert advisors, then it might be a good idea to have I just call it a reject trade strategy, so that within a specific time scale, for example, 1 hour before and 1 hour after midnight, that you don't enter any new trades. Still, you might have trades open at that time, but at least you would not open additional trades. And so, yeah, there are a lot of other possibilities to come around of that. Definitely what is important that you find an STP ECN broker like Argus FX, because those kind of brokers, they don't have any specific interest on your trading details. They only take your trade and forward that trade to their liquidity providers. And what does it mean? For example, if you have set a stop loss at a certain level, and what now finally will happen is, if that stop loss is reached, then your order goes to the liquidity pool as a market order. That's always the same. whenever stop loss or take profit is reached, finally that means that there's a market order, and that market order goes to the liquidity pool. And then, yeah, you get a price. That might differ from your stop loss value or your take profit value, but at least those kind of brokers have no specific interest. They earn the money with commissions, and that is what concerns them, not your single trade. Therefore, they don't have any interest of stop loss fishing or something like that, and therefore this is the best choice. What about if you have different strategies and different time scales? What kind of time frame you should use for the backtesting results? Try always the smallest one, because then you have, at least at my thinking, the best results. And finally, a very interesting principal idea that is related to the so-called reverse strategy trading. Finally, or starting that thought means you have a non-performing strategy, and with buy and sell signals, and now you think, hey, it might be a good idea to reverse that strategy if you have a non-performing strategy, and that non-performing strategy then will turn into a profitable strategy. By the way, I will, because I would only do some remarks here in short, I will do a complete webinar on that topic, because it's a very interesting topic from a more mathematical standpoint. And I know that a lot of people think that might be a good idea to have a non-performing strategy then turned into a profitable strategy. And the clear answer is, in most cases, it doesn't work. In principle, mathematically, it would work if we have spread values to 0 and a risk-reward ratio of every single trade of 1. Then it would work. But everybody knows that spreads do not equal 0, and we have different risk-reward ratios. Mathematically spoken, it means trading is not symmetric. You know that whenever you open a trade, in the next millisecond, you are in the minus, and that is right for all trades. Whether it is a long trade or a short trade, doesn't matter. Both trades would be in the minus in the very millisecond after the opening of the trade. And that is, by the way, one reason that trading is not symmetric. Just as an example, although that is only statistic 1, think about a strategy where you have a risk-reward ratio of 3 to 1, and your original strategy would reach the stop loss. What does it mean? Your reverse strategy then might not have reached the stop loss as well, of course, but finally, even that reverse trade must maybe end in the stop loss as well, because it doesn't reach the take profit. So only that the one trade has reached the stop loss doesn't mean that the other trade would reach the take profit. And there you can see already that this is that those trades are not symmetric. It's a statistic 1 case, but you finally will see that those kind of trades will ruin the reverse strategy as well. And one final remark on that, even just think totally different. There are thousands of non-profitable strategies. It would be extremely easy to turn all those strategies into a profitable strategy if we could simply reverse that strategy. So that would make trading quite easy, because most of the strategies are not profitable. So that may be a very strange view on that topic, but I will go into that once again with more details. Let's go to my slides back. And by the way, thank you for all those questions. And I like to have those questions because I think those are of common interest, and therefore I share in some cases my answers not only to the specific one who has raised those questions, but to everybody here as well. So my next topic is just one additional statement here, or simply an offering. You might until now not know that I do offer personal coaching for trading, and it's quite easy to get in touch with me. Just send me an email, and I do that very often with different people. And typically what we do is we review and analyze their trading behavior, for example, or I help with all my knowledge and my advisors with your own trading strategy, or even I assist you in the developing of your own trading strategies, so then you can profit from my knowledge, and I can help you to find good ways to develop your own and personal strategies. So just send me an email, and we will find a way and set up your personal program. Just a second here, because I have to stop my my Skype. Otherwise, we would have too often things here up and running. And therefore, just a second. Okay, now I'm back again, and just this coaching, I just want to mention here that you know that this is a possibility as well. Now let's move forward into the pair trading concept. And that is a quite interesting principal concept. And what does it mean when I talk about pair trading? There are other names for the same issue, and you can name pair trading as well. It's called ratio trading or spread trading, but all mean the same. What you always do is you look for two correlated underlyings, and whatever that means, correlated, that might simply be mathematically driven, that you find a correlation between two specific underlyings, or it might be more, I call those things story-driven, like, and that is my favorite example, that is Brent versus WTI oil. And because behind that pair, those two oil sorts, that you have an idea that the two prices of Brent and WTI, they cannot drift out, diverge for a long time. Simple story. If only one, for example, Brent would increase, and the WTI would be stable in price, then the industry would be changed after a certain time period, and they would consume more WTI and less Brent, and finally the two prices come together once again. So it cannot be in this case that for a long time the two prices would be too much different. And a pair trading strategy relies on the concept that the price comes together once again, so that it would be the basic statement of that kind of strategy. And in principle, a pair trading strategy always opens a long trade and a short trade simultaneously. So you would have finally two positions in your basket, in your trading account. And the underlying idea is that the two prices come together once again. In principle, the good thing is, if there's an overall movement in one direction still, like the price goes up, then in principle, both Brent and WTI would increase. That doesn't matter for you because you have a long trade and a short trade. So those would cancel. You profit of that concept only if the two prices come together. What sounds up to now maybe a little bit theoretically, I will show you in detail and then you will understand completely. So in principle, the story is that there's a temporary deviation of this correlation of two underlyings, and typically we know that they go into their normal correlation region once again. And that is exactly what we want to trade. But how does it look like? First of all, I want to share with you a paper on that. I put the paper already into the GoToWebinar panel, so you can download this one already, very easy. And that is a paper going back to 2006, and that is exactly dealing what I talk here today as well. And they use a slightly different approach, but they show that if you do the same concept on stocks, then you can finally have a very profitable portfolio or very profitable strategy. And you might go through the paper. It's easy to understand, and it exactly follows what we do now here in the Excel sheet. And once again, they look for correlation between two stock prices, two different companies, and always look for those which are correlated best. And then they have a candidate, and then they trade exactly that candidate. And yeah, you can find all the details in the paper as well. So, but it's worth to read, definitely. But let me show how I will do it here. And let's start with Brent and WTI with the prices. And what you see here in that Excel sheet is simply a long table with the two prices. Down to 2000, I took all the data from this internet website stock.com, STOO, and then a Q.com. There I downloaded all the data here for WTI and for Brent. And we have here all the prices open, high, low, close for more than 15 years. And yeah, that is the starting point. Let's look a little bit to the data, and I have prepared here already a couple of slides or a couple of pictures. In the first picture here, I have simply plotted the price against time, against the date, and yeah, what we see is that the two sorts of oil, they have strong increase until 2008, and then the financial crisis dropped the price down to $40 once again, increase. And yeah, 2 years ago now from today, there was a decrease of the price of both oils once again. What we see here in principle is the prices are more or less always very similar, very close to each other. There's only one period between 2010 and 2013 where we have had a longer period of bigger differences between the two prices. But in most of the time, the two prices are completely close to each other. Okay, but still we don't know how to trade that. But what we can do now, let's zoom into just the last year. And then you get already an idea how the pair trading concept would work. So it's the same data, but only starting from 1st of January this year. Then we see that in principle the two prices follow very close to each other. But sometimes you see already here, for example, where now my cursor is, the prices have been identical, and then for the next coming days there's a bigger difference between the two prices. And just let me only put another point here where now my cursor is, and the two prices come together once again. So let's think about those 2 points. So okay, at the first point we know the prices are identical. Then they diverge. And that would be a point to open those two trades, one long trade and one short trade. And finally, if the two prices come together once together, then we close the trade. And we have earned money. That the price has increased during that time doesn't matter, because we have a long and a short position. But since we have started our trade when there has been a bigger price difference, and now they come together, then this is the concept of pair trading and why we finally get profitable trades. Let's look a little bit more in detail already, a little bit from a mathematical point of view, because here for that example, WTI and Brent is a little bit easy in those kind of charts because the prices are really more or less identical. But think about a pair like gold and silver. Then we have totally different prices. But what we can do is we can build a quotient of those two. And I still do it here because then we can look how that looks like. So what does mean? I simply divided the price of WTI divided by the Brent price. And of course, in this case, because the prices are always more or less the same, this quotient is more or less a 1, nothing else. For gold against silver, we would have a huge factor, but in principle we will find similar results. But in this case, by the way, gold, silver, there are more phases of bigger difference in that ratio. So looking to that chart doesn't ring a bell, I think, that you already definitely know how the strategy works. But let's zoom once again into here. And this is only the last year. And that is always the ratio of the two prices, which is typically close to 1, but sometimes it's a little bit far away from that. What might be a very good principal idea is that we have a mathematical way to define when we should open trades and when to close. And there's a very easy idea, and that is put an EMA into the chart as well. I've done it here. This is an EMA of this ratio, and now we can see, okay, here we have a huge difference of the actual ratio against the actual EMA. That means that is a point in time when we should open such a pair trade. And when this ratio goes down back to the EMA, that would be the point to say, okay, I stop my trade. So it would mean we go for the difference between the actual ratio and the EMA on that ratio. Looking for that gives the following chart. So now I have plotted the difference between the ratio and the EMA of that ratio. And now we can set up a clear indicator of where to open a pair of trade. And that would be, for example, just two lines. One, for example, at 0.02 to have a trade pair opened with a long trade and a short trade, and maybe on the other side as well. But now then we would exactly reverse the way which should be traded long and which should be traded short. So we would open a pair trade exactly then when the price difference is high, and that gives us simply a limit, and that will finally be a parameter in our strategy. And we close when that difference crosses the zero. That would be the moment when we close exactly that trade. I hope you understand the basic idea. So whenever we have a huge difference between the actual ratio and the EMA on that ratio, we would open such a pair trade. And we close it when it goes back to zero. So that is the basic idea of this pair trading. And the good thing is that we can easily do our calculations already here within Excel. And I will show you the kind of concept and that you can follow this strategy by your own. And of course, once again, I share with you those kind of Excel sheets. By the way, one remark, I always send, in most cases, the Excel sheets with as ODS, which is LibreOffice. In order to get access to those kind of files, then simply install LibreOffice. You can find via Google very easy, and then you can open those Excel sheets as well. And by the way, then you can finally even export them as regular Excel sheets with an XLS or something like that. So then, by the way, that's quite easy. So it's called LibreOffice, and yeah, you will find it on the net. So how can we now go here to a complete trading strategy? Let me guide you already a little bit how everything is done here. And I want to go a little bit into the formulation and the formulas within Excel, that you really understand how this strategy has been developed. So the first here is that I build up the ratio. Simply, that is the quotient of, in my case, the WTI versus Brent. So simply divide those two numbers, and the same one would do, for example, if one would go for gold and would go for silver, then the same task has to be done. By the way, one additional remark here as well, when you download data, the first task you have always to do is that you really look that you have the prices for the same date. Sometimes there, within one underlying, you might miss a day, and in the other underlying there is such a day. That is something which normally happens when you download data somewhere, that they are not exactly complete. And so you have to identify those dates which are missing, and then you simply delete this line from the other one. Or that's at least what I think is best to do. I have done this task, of course, already, and therefore I can do my calculations here. So the first was building up this ratio. And then the second step is to calculate an EMA. And you might remember that there's a standard formula to calculate EMA values within Excel, and that's quite easy and always the same. Then the next step here is that I simply calculate the difference between the actual ratio and the EMA ratio. So that's all. That's all what I have to do here. And you see already that I have done a calculation in this cell as well, and that is I calculated the standard deviation of that ratio, or that difference between the ratio and the EMA. So that's what I have done here. And why have I done this? This standard deviation of the difference of the ratio minus the EMA value should give me a hint where to set that entry lines. Remember when I went here, and let's go back to this chart here, where I have plotted exactly the difference ratio against EMA. The question was where to set the specific line which tells me I should open a pair trade. And a good first hint is, of course, the standard deviation of this this chart. And therefore, I have done exactly that kind of calculation to calculate the standard deviation of all the differences between ratio minus EMA value of that ratio. So in this case, for an EMA value of 4, I have a standard deviation of, yeah, you see the number. And now how to create this trading formula within Excel here. And it's quite easy. What I have here is, at first, a column which I called entry signal. So in principle, whenever that difference is bigger than my standard deviation times a multiplier, then I should get a signal. And of course, there are two kinds of signals. This difference here might be bigger than, or on the other side, on the minus side, much lower than that threshold value. And that gives me a 1 here if I'm on the upper side of the differences, and it gives me a -1 when I'm on the lower side of that chart. So therefore, I have always here entry signals which fulfill my condition. If the difference is high enough, then give me a signal. Good. But now I cannot trade every signal, because in this case, if at that point in time here, when I have the first one, of course I should get an entry signal. Yes, now I should open a trade. But for the next time here, for the next candle, I would not trade the same signal once again, because now I have my pair open and I will not open an additional pair the next day. So I clearly have to look whether there's already a trade ongoing. And that's, by the way, the reason why I have a column with ongoing trades. So just let's go into the starting position of this strategy. What do I do here? So if I get an entry signal, I only accept that entry signal if I do not have a trade open. So that's the logic. And therefore, I go back here one line and look whether there's a zero, because only if there's a zero, I don't have a trade open. And that prevents me to reopen a trade when there's already a trade being opened. Finally, I store the values for my trade in WTI and my trade in Brent, the entry prices, which are, of course, the close prices I have here in my first columns. So in case I have a new entry signal, I take this value here as being the next, well, my entry price for that underlying, and do the same with the price for Brent. Now I know those entry prices. Now the question is, should I close my trade? And yeah, should I close my trade? Simply depends on those questions like, what kind of trade? Do I have a trade open? That's the first question. The second question is, what kind of trade do I have? So in case I have a so-called +1 trade, which is opened when my deviation is on the upper side, exceeding my threshold, then I want to close the trade when I see first time in this difference a value which is below zero, because then my difference between ratio minus EMA goes to the other side. And that is the moment, the signal for an exit of the trade. And vice versa, if my entry was a -1. So what means that I have opened a trade when I'm on the lower end of my deviation. And that creates me exit signals within that Excel sheet. And of course, whenever I have such an exit signal, I store here the end value of the trade. So finally, I have a trade being started, for example, for WTI, and the trade ends at that value. And the same for my Brent start value and my end value for the trade. And now I can calculate the percentage change of those two trades. But keep in mind that one trade is a long trade and one trade is a short trade. And you see here within my formula that I have a minus for this trade, for the trade of for WTI, and I have not a minus for the other trade. So that means my WTI trade was a short trade which has earned some money, going from 24.91 down to 24.67, and this is a short trade and therefore gaining money. And the other one has been a long trade. In this case, we have it went down, and we have for a long trade, therefore a minus percentage change. Finally, what I do here is I add up all those trades. So within that column, for example, I get the trade result. No, sorry, in this case, in the column Z, I get the summation of those two trades. And then finally, I can build up something like an equity curve by summing up all the values once again. And how does it look like? It looks like this. Just to interpret that kind of picture, what you see here is the individual sum of all trades with WTI, having long trades, having short trades, always according to that kind of strategy, and for the Brent, all the Brent trades as well. Finally, because we do the summation of all, I enter with a yellow line, which would be finally the equity curve of that kind of strategy, which looks quite well. The good thing is now I can change the values. I can change the values for my threshold, because finally I have two parameters within my strategy. And let me bring the picture here to the values. Just a second. And I need a little bit more. Okay. Now we have everything together. So we have two parameters here we might change. And let me mark those two parameters in yellow. I have an EMA value, and I have this multiplier, which is applied to the standard deviation of all the deviations between the ratio and the EMA value of that ratio. And what we can change now is, for example, we can say, okay, let's increase this multiplier, and then we can immediately see what happens with our equity line, whether it went well or worse or whatever might happen. Or even we can change, for example, the EMA value to totally different numbers, like 30 or even 100, and so on and so on. So what we can see, of course, when we go to higher values of EMAs, then the number of trades would be reduced dramatically. And the same applies if I increase the multiplier, then we get less trades. Once again, by the way, I have here a number, simply the sum of all exit signals, and that number tells me how many trades I have done within that kind of strategy. So it's easy to play around. We have finally here a two-parameter strategy, which is good because it's only two. We have an EMA value and we have a multiplier for being our threshold when to enter a trade. What I have done here, I built something like the slope of that equity line. That is one number, and then another number is this R square, which tells you how close is the equity line to a linear behavior, a complete linear behavior. And then in order to get a final single number, which can now be optimized playing around with EMA and threshold, entry threshold, in this case, I took this R square being the number of the linearity of our equity line with a power of 4 in order to emphasize that I want to have linear equity lines, and I multiply that with the slope of the equity curve. So therefore I have a single number which I try to optimize here by playing around with my EMA values and threshold values and so on, because I don't look really to the equity picture. I always look only to that specific number, and then I can play around in order to find the best strategy. So the task means to maximize this single number. Of course, I have done this, and I this is the single number I'm now heading for, and I build up this kind of table here. The table has values for that multiplier, being the threshold, the entry threshold of our signals, and here downwards I have the different EMA values which I tried, and within that parameter space, from starting from 2, value of 2 with the EMA going up to 512, and you see my steps in the multiplier threshold value. Yeah, and then just for illustration reason, I plotted 2 graphs here. Let's bring me this one first. So here we have fixed values for the threshold, and then on the on the x-axis I have the different EMA values. By the way, I take the logarithmic scale, which is always suitable for EMA values, and then I have this single number telling me the profitability of my strategy. The higher the better, and you see within that region I have good values, and within the lower region of EMA values I have good strategies. But to tell you the best first, at least it's always profitable, always. So I don't have a single negative number within that kind of calculation. And let's look to the other principal drawing we can do with those data. Now I have fixed the EMA values, and you find the profitability versus the threshold values, and then we see, okay, in the middle range we have the highest values for our profitability. Within my table I have marked a few. The absolute maximum within the table is an EMA value of 4 and a threshold of a threshold multiplier of 1, but there are other good values as well. In this case I only took some averages here in order to show me where I can find the best values. But that would mean, for example, I would say strategies around, for example, here, they are good as well. But up to now, it's first for illustration. So I can build up that kind of table. I know now for that kind of strategy that it's profitable more or less whatever parameters I take, which is very good. And there's one reason behind, and that is what when I introduced the strategy, what I called the story of Brent versus WTI. This kind of story is good because those two prices cannot differ very much for a long time, because there's a mechanism which always brings back this difference to, let's say, a normal value. And therefore, this kind of strategy is quite profitable here. So, still, I want to show you at the end of my webinar once again the way how those trades are derived, because still you might ask yourself, hey, and what should I trade long and what should I trade short? Let's assume that within this just a picture of a price change, we have already the following situation. Here we have the Brent price, which in my case is higher than the WTI price, and let's say that are candles, or that is a price. So the price went upwards. Okay, fine. If we would have such a situation, that would not give us any trading signal. But now let's assume the following. Let's assume that this price goes up as well, still, and here we get a downwards movement. And the next candle, maybe once again, we have something like here. And immediately you know what would happen to the ratio of those two prices. In this case, this ratio would went up. If I take the ratio Brent divided by WTI. Let me change it because within the other Excel sheet, I have done it vice versa, and then I have the same logic here. So it's only naming. So the WTI price went up, and now we have the situation they diverge. The one goes still up, and the other one goes down. And now this is the moment we would open a short trade on WTI and a long trade on Brent. What might happen from now? Of course, maybe the two prices will go up. Then I would not lose money because I would earn money with a long trade and I will lose money with a short trade. Okay, that's understood. But what I expect that in some times, in some candles, the prices should come together once again. And even if it would go, let's say, this way, that this price goes up and this price goes up by 1 as well. Now, okay, I have not earned anything because I lose the money with my short trade and I win money with my long trade. But when finally, for example, the prices come together once together, then let me illustrate it this way here. Now you see how we benefit from that trading strategy. Of course, we still have a loss in our short trade, which is overcompensated by our long trade. And that is why the strategy earns money. Of course, we know that if they don't come together once again, then the strategy would fail. But we know from history that it has been a good idea, at least for the last 15 years. So that is already the base of that strategy and why, especially for Brent versus WTI, it should work. If you think about a ratio of S&P 500 versus DAX, of course, we know in principle they follow each other. So that's okay. Therefore, it's in principle a good idea to do ratio trades on that pair as well. But there's a but which is stronger than the but for a potential loser trade in WTI versus Brent. What would happen if America becomes great again? By the way, yeah, you know why I tell you in that way. And Germany would have problems. Then there might be a long period with an increase in S&P 500 and a stagnation or even a decrease in DAX. There we have principal things which might go wrong. That means that those two underlyings, those two indices, they don't come together once again. The strategy works on those two indices as well, but the potential loss is higher because there might be longer periods where those two underlyings diverge. And that is then finally a problem. Still, we are not ready. We are not finished. And I will do the rest within the next webinar because, as you know, we have a problem. Not a problem, but two things we have to consider. One is, what about stop losses? And you know that this is always something I have to take care. And the other one is, I did the calculation without spreads. And of course, I know already by my my instinct here that especially if I go for low EMA values, when I have lots of trades, then the spreads become especially important. So we have to do our spread calculation here as well, to take those values into account. And then I will show you next week what about stop losses, what about other pairs, and how finally really to trade. It's easy to say I go long with the one and short with the other, but finally we have to calculate lot sizes, for example, for those trades. And we have to combine it with an account size in order to have real numbers. For Brent WTI, it's more or less in most times very easy, because the lot sizes of both trades would equal because the price is set close. But for example, if we would trade DAX versus S&P 500, there's a total different story. Because we have to get so-called same trades, same amount trades, and we cannot open one lot S&P 500 versus one lot DAX. That would ruin that kind of strategy. So there need to be a balance via the lot size, and how to calculate this finally I will show you next week. So, but already the 1 hour is all over. Always astonished me how fast everything went here. As always, you know how to reach me. You get in touch with me, send me emails, send me questions, and how to get in touch with Argus FX as well. So everybody is welcome to do so. For now, I wish you a pleasant day, and see you next week, hopefully. Okay, thank you very much for your attention. Bye-bye.